Hey everyone, my name is Jack. I'm a 23-year-old real estate investor and soon-to-be attorney, and on this channel I cover a variety of topics as they relate to real estate investing, the markets, and pretty much everything as it has to do with personal finance. So if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. But today I want to talk about the stock market, which has been catapulted by the recent news about Pfizer's new vaccine that has been apparently 90% effective against the coronavirus, which is fantastic news, no doubt. If this vaccine really does work on a broad scale, this is fantastic not only for the United States, but also the rest of the world in getting us out of this horrible pandemic. But a secondary effect of this news is that the stock market has surged to all-time highs back up to its March levels. Investors are clearly hopeful that this vaccine will work, and they assume that if this vaccine does work, the economy will get back to normal very quickly, and therefore the companies that make up the stock market will be doing better performance-wise. Now, all of that might be true, however, I see a problem in how expensive the stock market has become even on this great news. Because before this great news, the stock market was already surging and was doing really well despite the horrific economic performance across the board, not in the United States, not in the world, everywhere. It was all over the place. We had unemployment rampant, we had government shutdowns, we had everything that pretty much could have gone wrong for the economy going wrong. That is, until the government stepped in, took out a mammoth amount of public debt, had the Fed mainly and central banks around the world did the same thing, pay for these gigantic stimulus programs and paying for all the losses that the economy was suffering, or at least many of them. Companies got bailed out, businesses got forgivable loans, there were grants everywhere, we had eviction freezes, we had foreclosure moratoriums, all sorts of different stimulus programs to try and pause the problems and then also regain many of the benefits of a healthy economy. However, you cannot replace a healthy economy just by printing money and debt spending. This is where my current problem with the stock market comes from. It is currently priced for a perfect outcome. That perfect outcome would be the vaccine is released promptly, everyone goes back to work, everyone starts spending again, and there are no problems from all the stuff that happened before, and we're all good. We're already at March price levels, so let's take the March situation right before the pandemic really hit the US and everyone started panicking, and we had the huge sell-off and all of the economic bad doings that happened. In that February and early March economy, do you think that we were in a better or worse position than we are now? Do you think companies were in a better or worse position than we are now? Now, some select companies are most certainly in a better position than before, however, many more are not. Unemployment is still much higher than before, we're up around 7%. It is still much lower than it was just a few months ago, but it's still a much higher number than we had in February and March. That's a ton of lost income, that's a ton of lost spending, and a ton of lost production as well. That was simply replaced by debt. That debt is going to have to be paid through some means. Now, I guess you could say, luckily for investors, a lot of that was paid for by the Fed, and the Fed has to print new currency or really just types digits into a computer. Then we have all this new currency on the books, new debt can be issued, and that helps to prop up the economy in a way through inflation. I shouldn't say it props up the economy, but it does prop up asset values. And these assets include stocks. The reason that printing props up asset values is because you have the same amount of assets as before, yet you have more currency to pay for them. It follows that that currency is worth less than the asset itself, so in dollar terms, the asset looks like it is much more expensive because it is in dollar terms. The value of that asset itself has not changed, but the price has. So I'm sure some of the price surge that we've seen in the market over the past many months has been a result of some sort of currency devaluation. A lot of it does kind of lag behind, though, when it comes to inflation. So it's hard to tell how much exactly is from pure printing and inflation as opposed to actual economic recovery. But either way, the S&P 500, for example, became increasingly absorbed by 5 companies at the very top, giant tech firms mainly, and these firms have massive price-to-earning ratios. Granted, that's not the only measure you should look at, but it is a quick tell to see how expensive the earnings that a company is going to give you, and typically the higher the price-to-earnings ratio, the more growth you're going to need in the long term to really make that investment worth it. Are a lot of these companies going to continue growing? Sure, I bet most of them would, and they probably will be pretty close to their projections. But the thing is, the way they're priced and how expensive they are right now, you need that growth to happen, otherwise this investment is a bust. There's not really any value, and there's not a lot of cushion on the downside since people are buying things while they're so expensive. The stock market, in many places at least, does feel like it's nearing bubble territory, and that's really nerve-wracking going into next year. There is a lot of anticipation for more stimulus as well, which isn't always a guarantee, so if there's no stimulus, you'd probably expect more downside on stocks as well. The point is, there are a lot of factors that really need to happen. You need these companies to grow a lot. You probably need more stimulus, and you probably need more currency devaluation from the Fed to keep these asset values going up the way people people are expecting them to. And this is on top of the fact that if the vaccine doesn't work or isn't issued properly or something goes wrong with it there, that could have even more negative effects on the market from its current high. So what am I doing through all this? Well, I do cover my investments in detail on this channel. In fact, on the 15th of every month, I have my M1 Finance stock portfolio series where I go over a portfolio I'm trying to build up to $100,000 in M1 Finance. I'll go ahead and link that playlist up above right now. But in general, what I'm doing is I'm actually selling off index funds for the most part that are mostly in the US markets, and I'm selling those off, mainly paying down some debt, but also building a new cash reserve. Things have just gotten so expensive that I think the risk to reward ratio is just not there for what I want as an investor. My decision might look very different than what yours is, but I'm at least giving you my take on what I think the market is doing and what I think is wrong with it from my own perspective. Yours, again, might be very different. I'm not a financial advisor after all, so please don't sue me. But a big principle that I'm trying to be very careful with the stock market now, which I really wasn't doing before, is really looking for value and looking for companies that are cheap rather than those that are expensive, even though they might be good on their face. For example, many of the big tech firms, Amazon, Tesla, Google, they are great firms that I think are going to do great over the long term and are probably going to be growing a lot more from here. However, just because the company is great and I think it's going to do well does not mean that the stock, I think, is priced properly. Because of that, I'm holding off piling into these companies even though I think they're great. I'm trying to look for more value plays, looking for things that are cheap, not expensive. And if I just keep that fundamental analysis going, making sure that I'm only buying things when they're cheap, much like a piece of real estate, trying to buy something under market value, that is the ultimate goal with investing, in my view. When you invest for value or when you invest when things are cheap, that means you are not only limiting your downside because you already have a cushion built in, but you're hopefully catapulting your upside returns as well when things start to get better again. This could be the general market actually seeing the value that you saw earlier, or it could be something in that company changing that you were thinking was going to happen. The point is you have to try and find things that the market isn't seeing or isn't quick enough to get to in order to get that value premium locked in. Otherwise, you're going to be paying a premium on the other end by buying something when it's expensive. Again, this doesn't just apply to stocks, it applies to any sort of investment. You never want to pay more than you have to, and you never want to pay more than what you think it's fundamentally worth. Now, you might totally disagree with me. You might think the stock market is totally undervalued, and that could be valid not only because you think there's going to be a lot of currency devaluation, but because maybe these earnings projections are very low in your opinion, and you think they're going to be way higher for many of these companies. You could totally think that. Either of us could be right in the long term. It's hard to say since no one actually has a crystal ball. But I'm still trying to play the odds in my favor. If I think something really is undervalued, I'm going to put money onto that, not onto something that I think is good but overpriced. The best of both worlds is a good company that is underpriced, and that is exactly what I'm going for at all times now. These opportunities are few and far between at the moment because of how expensive the market has gotten really throughout the world, so I have to be very careful and disciplined in my analysis in trying to find those companies. Anyways, that's all I've got for today. I just really wanted to point out that I think this market is really priced for perfection, and if that perfection doesn't come, there might be a bit of a pullback that's going to harm a lot of people. Could be wrong, but that's my hot take. But if you like this video, please like it since it helps the channel out a lot, and if you like this sort of content about investing, the stock market, the markets in general, real estate investing, definitely subscribe since I put out new videos every single week and I wouldn't want you guys to miss out. And check out my book, The One Property Retirement, about a simple strategy for building your retirement nest egg using real estate. It's great for beginners who might be unfamiliar with the real estate process, since it takes you from the very beginning, from running the numbers and vetting the deal, through the closing process and beyond with maintaining and renting out the property. If you end up reading the book, definitely leave a review on Amazon since that would help me out a lot. But until next time, take care.